Welcome to the show this morning. It is 17 minutes after 6 o'clock. You know, it'd be better if I lived in New York, 'cause it'd be 17 minutes after 7, which means I got to sleep in more.
I don't think it works that way.
Does it?
No, if you lived in New York, you would actually have to have been up earlier there than here.
I'm just teasing.
I'm just trying to help you straighten you out on a Monday.
So really, what you're saying is we should be in California.
Yeah.
We could sleep in 2 more hours before we have to do the show.
California, all of California wakes up a half a day after everybody else.
Probably true. All right. Well, on Friday, the markets had a nice up day. And, of course, it was important because the markets had come down. We were kind of flirting around with the, recent support here at the 50-day moving average. And what we needed was this market to really find a little bit of footing here. We saw that on Friday. But it wasn't because of, better than expected economic numbers or earnings reports. No, it was the Federal Reserve. And it's interesting because, and we're going to interview, we've got an interview getting scheduled with Danielle DiMartino Booth. In fact, I was tweeting her over the weekend. And well, actually, that's not true. I didn't tweet her directly. I tweeted all of my followers, and I said, hey, tell Danielle to get out of bed earlier so we can get her on the podcast. So
something about her wanting to have TV makeup before she'll come on now, since we're doing the show on live stream.
Yeah, no, she wants to be. Well, she wants to look pretty, and it's okay.
Well, she's a great looking woman.
Of course,
she doesn't need any help.
I understand that, but she wants to look pretty.
All right. Okay.
But anyway, so I had all my Twitter followers ding her this weekend to tell her to get on the. So you should be reaching out to her today. So
we've been bouncing back and forth our own emails.
Yeah. Good.
Yeah.
All right.
So we'll get her on.
So we're gonna because she's a good friend of mine, and we've known each other for years. She came down to Houston to one of our big investment conferences and was speaking there. She used to work for the Federal Reserve in Dallas, so she's got a lot of insight into how the Fed actually works. That's why we like to tag her every now and then. But when Jerome Powell was nominated to the Federal Reserve, she was very excited about this because this is the guy about 4 years ago who was talking about quantitative easing and Fed policy and the problems with it. In other words, the outcome of these policies was not going to be what everybody expected ultimately, and that the Federal Reserve needed to extract itself from these policies. Now, this is the guy, right? So this is Jerome Powell saying this about 4 years ago. And that, this continued run of monetary interventions was ultimately going to be problematic for the U.S. Well, it's interesting. He becomes Fed chairman, and Danielle DiMartino Booth, she was very excited. She goes, "Hey, this guy's a different animal. He doesn't care about politics. He doesn't care about markets. He is all about monetary policy." And so what we were looking for was a real change, and we got that initially. We saw a Fed chairman that came in. He's like, hey, I don't care what's happening. He says, we've got to raise rates. We're worried about economic growth overheating, so we've got to raise rates. We've got to reduce this balance sheet. So they started this process of reducing the balance sheet, got it up to $50 billion a month, extracting capital off their balance sheet. So we saw a reduction in the size of the balance sheet, small smidge. If you really squint at the size of the balance sheet, you can actually see it's actually a little bit lower than where it was a couple of years ago. But you have to really look pretty hard. So the problem, though, is that this liquidity that's been provided by the Federal Reserve into the markets is what's been elevating asset prices. So obviously, when you start extracting that capital, guess what happens? Asset prices don't like it too much. And so last year we had a 20% decline roughly from the highs of the year. But for the entire course of the year, the market was only down 4.4%. Now, we had a lot of volatility in that process. So a lot of people think it really, if you ask the majority of people, how'd the market do last year? Oh, it's terrible. It's down like 20% last year. No, it's down 4% for the year. A little over 4%, like 4.4%. But it seemed worse because of all the volatility. It's like, oh, man, I lost all this money last year. Well, nah, not really. No, you didn't. But what's interesting is that the market's down 4.4%. The White House is all over the Federal Reserve about hiking interest rates and reducing their balance sheet and quantitative tightening. Donald Trump is all over Fed Chairman Powell, threatening to fire him, all kinds of stuff. But yet the diehard Powell supporters continued to say, no, he's a different animal. He doesn't care. Turns out he does. Because on Friday, Wall Street Journal reported that the Fed is now considering ending sooner their quantitative tightening. In other words, the reduction of their balance sheet. Now, what does that mean? Right? So a lot of people are like, I don't understand what the hell you're talking about. I get it. In order to get the economy going in after the financial crisis, the Federal Reserve said, you know what we're doing? We're going to lower interest rates, right? So we lower interest rates, and that gets people borrowing again. So we loosened up lending standards. We lowered the interest rate to zero, which drug down all the other interest rates with it. So all of a sudden, you're getting a mortgage for 30 years at 3.5%. Now think about that for just a moment. Let's say you've got money, and somebody comes to you and says, Brent, I want to borrow some money from you. You go, great, okay, how much you need? I need $100,000. I want to buy a house. Okay. Now, the person you know, he's a pretty good credit, right? It's not like your cousin Vinny that never pays you back. You know, you've known this guy for years. He's got a good, stable job. The odds of him paying you back are very high. So it's not a credit risk issue we're talking about here. But I still want to ask you the same question. Now, we know that inflation in the economy runs about 2.5% reality, right? You know, and it's really higher than that once you start including things like energy costs, tuition for college, insurance costs, healthcare costs, blah, blah, blah. So it's actually higher. It's probably 3.5%. Reality is what we pay in inflation every year. So Brent comes to you and says, hey, I want to borrow some money. And you go, hey, he's a good guy. I'll loan him some money. What are you going to loan it for? 3.5%. So this is the problem. We had people borrowing money for 30 years. Now think about this, 30 years at 3.5%. The rate of inflation is about that. So your return on investment for that loan over 30 years is zero. But this is what we did. And we did that in order to get the economy going again. We needed to get money flowing through the system. And in order to support that, the Federal Reserve started buying bonds out of the market. So they would go to, so now the Federal Reserve can't buy bonds directly from the Treasury, right? So they have to, the Treasury issues the debt to fund our spending. So we're running $1 trillion in a deficit right now. And so if you say that, well, we're going to make $600 billion in tax revenue this year, the differential between the $600 billion and the trillion that we're spending is $400 billion. So we've got to issue out $400 billion in new debt. Well, the Federal Reserve can't buy that debt directly, so it has to go to what they call member banks. Member banks are your, Bank of America, J.P. Morgan, et cetera. There's 20 primary institutions that buy directly from the Treasury. Once those treasuries are bought by those primary institutions, the dealers, then the Federal Reserve can go to those banks and say, hey, I'll buy $1 trillion worth of that bond from you. You give it to me, I'm going to give you the money for it. And so the banks get the money, the Federal Reserve gets the debt, and that's how money gets into the system. And that's why we had this that was the whole premise of quantitative easing, was to put a lot of capital into the hands of the banks so that they could invest that into equities. And exactly what happened. So we had this big boom in the stock market over the last decade. So it was great. But the money didn't come from economic growth and actual productive activity. And this is why over the course of the last decade, while we had a booming stock market, yeah, it went up, 200 and some odd %. Great. If you were lucky enough to be invested in the markets, you did well. The problem is about 85% of America has no money invested in the stock market. So it really bypassed the majority of America entirely. But that's why we have this big wealth concentration in the hands of those at the top. So we had this big influx. Well, and the theory is that once the economy and these are called emergency measures, by the way. These are the things you do in the midst of a financial crisis to keep the world from falling into the second Great Depression. Right? That's when we did these emergency measures. And it was not only just the Fed that did this, by the way. It was also the ECB, the Bank of England, the Bank of Japan, the People's Bank of China. Every central bank in the world did exactly the same thing. This was a global financial crisis, and every central bank jumped into the fore to just flood the entire system with liquidity. And it created a big wealth gap. In fact, since 2009, the world's billionaires have more than doubled their combined wealth. All the billionaires in the world have about $3.4 trillion in 2009. By 2017, that had doubled to $8.9 trillion. In fact, the top 3 wealthiest people in the U.S. alone own more wealth, those 3 individuals, than half the country combined. So it just goes to show you how this benefited those at the top, but not really those at the bottom. And Jerome Powell didn't really care about that, supposedly. Well, we'll come back. We'll tell you what he did on Friday and what the Fed's saying. And we'll talk about that. Make sure and get by our website, lancerobertshow.com. Our latest newsletter is out from this weekend, so simply click on the newsletter link. And also try out our new professional version of our website, riapro.net. We publish articles every single day talking about buy and sell positions in the markets, sectors, individual stocks, portfolios. There's actually our live portfolios that run there, so you can track what we're doing. You can also plug in your own portfolios and track what you're doing as well. All the analysis there for you. Simply check it out, riapro.net. That's RIA, Real Investment Advice, riapro.net. And plug in the code Bear Market right now for 1 month free to try it out at no risk. There you go. We'll be right back after the break. I'm your host, Lance Roberts, right here on The Lance Roberts Show. Get by our YouTube channel, Lance Roberts Show at YouTube, and get all of our podcast videos and more. Be right back after the break.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertsshow.com.